Most people think tax planning happens in January. In UK, the smartest moves happens before April 5 because once the tax year closes, some allowances reset, and from April 6, 2026, some tax rates, including dividend tax for many directors, get worse. That means thousands of pounds in legal tax savings can simply vanish overnight. I'm Rubina, a qualified accountant with 20 plus years of experience helping small businesses to save taxes legally. In this video, I will show you 7 completely legal tax moves you can still make before the end of the tax year based on HMRC rules that business owners, company directors, and high earners use every year to reduce their tax bill. And number 3 is especially vital if you run a limited company and take dividends. So stay with me because missing just one of these could cost you thousands. Number 1, use your ISA allowance, £20,000. Let's start with the ISA. For the 2025-26 tax year, the overall ISA subscription limit is £20,000. And gov.uk's published 2026-27 rates still show that same £20,000 overall ISA limit. So for this video, the message is simple. If you do not use this year's ISA allowance by April 5, you lose that year's allowance forever. Now, you may have heard of a 12,000 ISA limit. That is not a journal ISA cut next year. The official update says a £12,000 annual subscription limit for cash ISAs is planned from 6 April 2027 for investors under age 65. While the broader ISA subscription limit shows for 26-27 remains £20,000. And the reason ISAs are so powerful is simple. Inside an ISA, no income tax, no capital gains tax, no tax on withdrawals. This means if your investments grow significantly over time, that growth is completely tax-free. Now, here is the catch. The £20,000 allowance resets every year April 6. If you don't use it by 5 April, you lose it forever. It doesn't roll over. This is why investors who build serious wealth tend to treat the ISA allowance as a yearly priority. Over time, this creates a tax-free investment engine that compounds without HMRC taking a cut. Number 2, pension contributions before year end. And this is where many high earners unlock some of the largest tax relief available in the UK. When you contribute to a pension, HMRC gives you tax relief based on your income tax band. Basic rate taxpayers get 20% relief. Higher rate taxpayers get 40%, and additional rate taxpayers can receive up to 45% relief. For example, if you contribute £10,000 into a pension, the effective cost could be £8,000 for basic rate taxpayers, £6,000 for higher rate taxpayers. The government is essentially subsidizing your retirement savings. Now, the annual allowance is typically £60,000 per year, subject to income limits and tapering for very high earners. But again, the key rule, pension contributions must be made before the end of the tax year to receive relief for that year. So, if you were planning to contribute anyway, timing matters. Number 3, dividend timing. This is where year-end planning gets very real for limited company directors. If you take dividends, timing matters. But this year, it matters even more. Why? Because From 6 April 2026, the government is increasing the basic rate to 10.75% and the upper rate to 35.75%. That is a 2 percentage point increase on both. The additional rate stays at 39.35% and the dividend allowance stays at £500. So, if you are already planning to extract profits, there is a genuine tax planning question here. Is it better to take some dividend income before 5th April 2026 while the current rates still apply, or defer into the next tax year? The answer depends on your total income, your tax bands, and how much unused basic rate band you still have. But the key point is this: the dividend tax landscape is getting tighter from April. Now, this one is particularly vital if you own a limited company. Dividends are often one of the most tax efficient ways to extract profits from a company. But timing those dividends across tax years can make a big difference. For example, if your personal income is already close to a higher tax band threshold, taking a large dividend before April could push you into a higher tax bracket, but delaying it until after 6 April could reset your tax bands. Directors often use dividend timing strategies to utilize unused personal allowances, stay within lower tax bands, or spread income across multiple years. Another key point: the dividend allowance is currently £500 per year. So, planning how dividends are distributed and when can significantly affect your personal tax bill. I did a full video breakdown how directors can pay themselves tax efficiently, so the link is here on screen. Number 4. Use your capital gains tax allowance. If you sell an asset that has increased in value, such as shares, property, or investments, the profit may be subject to capital gains tax. However, every individual currently has a £3,000 annual CGT exemption. This means the first £3,000 of gains each year are tax-free. But again, the same rule applies. If you don't use it by 5th April, the allowance disappears. Some investors use a strategy called bed and ISA or bed and spouse. This involves selling investments to realize a gain within the allowance and then reinvesting them inside an ISA or transferring to a spouse. The goal is simple: use the annual tax-free allowance before it resets. Number 5. Marriage allowance transfer. This next one is often overlooked, but for some couples, it can reduce tax by up to £250 per year. It is called the marriage allowance. If one spouse earns below the personal allowance and the other is a basic rate taxpayer, the lower earning spouse can transfer £1,260 of their allowance. That reduces the high earner's tax bill. It sounds small, but over multiple years, this adds up. And importantly, you can also backdate claims up to 4 years if you were eligible. Number 6. Director bonuses versus dividends. For company directors, another year-end planning decision is whether to take income as a bonus or a dividend. Bonuses are treated as employment income, meaning they are subject to income tax, national insurance, employer NIC. Dividends, on the other hand, are taxed differently and typically do not attract national insurance. However, dividends can only be paid from available company profits. So, year-end tax planning often involves analyzing company profit levels, personal tax thresholds, national insurance exposure to determine the most tax efficient combination of salary, bonus, and dividends. This is why many directors review their numbers in March, not in January. Number 7, electric company car benefits. And finally, a tax strategy that has become increasingly popular in recent years. Electric company cars, under the current benefit in kind rules, fully electric vehicles have extremely low BIK rates. Compare that to petrol or diesel company cars, which can have BIK rates way higher. That means a director could drive a £50,000 electric car with a surprisingly low personal tax cost. Meanwhile, the company can usually claim capital allowances and corporation tax relief. This is one of the few areas where the tax system is actively encouraging a specific behavior. But again, these benefit depends on timing and tax year planning. Each of these strategies are completely legal under HMRC rules, but they only work if you plan before the tax year ends. Once April arrives, the window closes. If you found this video helpful, make sure to subscribe to the channel. And if you want help reviewing your year-end tax position, the link to book a meeting is in the description. When it comes to tax planning, the difference between March and April can literally be thousands of pounds.